Welcome to a new episode of investology. We're going to discuss private credit and distressed debt with an expert that has spent over 30 years navigating that space, Daniel Bird. Daniel, welcome to the show.
Thank you. Happy to be here.
To set the scene, if we look at private credit in general, it used to be something, I would say, fairly obscure in the field of finance, reserved for specialists. And now I must say that I hear about it a lot, which expresses my personal interest, but I think it's also grown very significantly and become an important part of the news because we hear of those structured private credit deals, for example, between Blue Owl and Meta, just to name one of them. So could you give us just a big picture of the asset class and its evolution to start with?
Sure. Yeah, look, I think the term private credit means different things to different people. I think in general, private credit was really born after the financial crisis back in 2008. The banking sector went through significant changes, more regulation, more scrutiny on their balance sheets. So a lot of the lending that banks did, both in Europe and the US, became more difficult for them to do, which created an opportunity in the market for private credit institutions to kind of grow. You know, there's been growth both in the US and in Europe. Companies have been set up to focus exclusively on private credit, and existing asset managers that were in place at the time that were mostly in credit, moved into the space. And, the growth has been enormous. I think I was reading the other day, I think the private credit market in Europe is as big as the high yield market now. The growth has been astonishing. And it's a very popular thing. Just want to make sure private credit means a lot of things to a lot of people. I think when I talk about private credit, it's generally direct lending is what I'm talking about. And direct lending means financing for financial sponsors to do LBOs, which is, in line with what the high yield market or the syndicated loan market is. There are other parts of private credit, which are a little bit more opportunistic. Some people call them capital solutions, special situations, if you will, and other things. There are a couple of people who have tactical credit funds, which mainly get into private credit, but sometimes do public credit as well.
From what I understand, it's an ongoing trend from the financial crisis, and it's driven really by the appetite for investor and also by this whole growth of private assets in general, right?
Yeah. Look, some investors like private assets because they don't have to mark them to market. Private equity portfolio, if a private equity manager raises a fund, usually that's a 5 or 7 year duration fund, and sometimes it takes even longer to get returns and capital back. During that period, very rarely are those assets marked to market. So for some investors, that they like that in terms of managing their overall portfolio, where you might in the public markets you might have significant volatility up and down, like we saw in the first half of this year. In the public markets, a lot of those portfolios don't get marked to market, and it's diversification for sure.
You mentioned the lack of volatility or the lack of market, and obviously it's I can understand that if you lend directly to a set of company, it's very different from your traditional public portfolio. We need to talk about performance here. Can you introduce us this idea of performance in that field?
Yeah, sure. I mean, I think there's a lot of discussion in the market now about private credit portfolios and whether they're marked correctly or being evaluated correctly by the market. There's a lot of information out there that's contradictory, right? Some of the big asset managers, you'll hear from the top guys, Apollo, Blackstone, that they still believe in the product. And then there's other people out there calling for effectively maybe there's a bubble in parts of private credit. It's hard to say, right? It's really hard to say without having visibility into really the underlyings. Because the assets aren't marked to market, it doesn't mean there's not volatility in the underlying portfolio companies, right? It's hard to imagine that a portfolio of private credit investments will not have any volatility. A lot of these investments would be rated sub-investment grade for sure, and probably a lot of them at the lower end of the sub-investment grade universe, meaning lower single B type structures. So there is volatility in those assets. It's just not getting expressed in the mark to market. If you look at there's something called a BDC, a business development company, which is a listed entity that invests in private credit type assets. There are entities out there that are in the market that are trading at a significant discount to the net asset value that's represented in the portfolio. That implies that there is weakness in the underlyings, but it's hard to say without doing an individual analysis of the underlyings. Look, is there some stress in those portfolios? I'm sure there will be. Like there's stress in the high yield bond market or the syndicated loan market. I'm not sure that it's more worrying than that. I think those portfolios will perform in line with the market. That being said, there's a little bit of worry about there have been periods of deployment in the last few years where you've had significant spikes in deployment. I think 2021 was, a huge year for deployment. There's worry about some of the assets that were originated in that period will have a little bit more stress. It's possible. It'll take a little while to kind of figure that out. From my perspective, that just creates different opportunities, right? I think, the BDC that I mentioned, for example, it's trading at a discount to NAV. That might actually be a good investment. And, for people like me who try to focus on opportunistic parts of the credit spectrum, that might end up being a really good investment. The secondaries market, this is limited partners of funds that are transacting and selling their LP stakes to other buyers. Those typically trade at a discount to net asset value. That could turn into be, a good investment. And I think a lot of players have been moving into that space, thinking that it's so. Do I think there's anything is it an alarm that's gonna impact the economy in a big way? I don't think so. Does it create idiosyncratic opportunities? Absolutely. And that's what I think people should be kind of focused on. And there are some really good people out there that are able to capitalize on those types of opportunities, that have the expertise to work through sub-performing assets or distressed assets if they get to that point. And, I suspect that's going to be a little bit more of a growing and more active part of the credit market.
Yeah, that's what's fascinating from an investor's perspective is how many layers there are, how many opportunities there are, how much skills there is in managing this, because from what I gather, it's not just financial skills, it's also about the structure, the covenant structure of the deal. So it's probably a legal skill and stuff like that. And therefore, I can imagine that someone who has time and energy and experience and skill into that can deliver very differentiated results. Then how do common investors link to that? That's a very different ball game. But now that we've got, let's say, the broader picture, I think it's interesting to go down a bit further and focus on something. But because, as you mentioned, there's so many asset classes, should we call them asset classes? But as you said, special situation, direct lending, distressed debt, is that the right terminology?
Yeah, I think distressed debt, people use that term less and less nowadays, right? I think that term is probably from the 90s, to be honest, right? And kind of carried over into the early 2000s. You don't want to actually put a shingle out there that says distressed debt, right? Because, if you're owning if you're going and trying to help a company and your business card says distressed debt, sometimes they get scared. So I think the term special situations or opportunistic credit or capital solutions, that has really replaced the kind of distressed debt in the market. But it still exists, distressed debt, and it's part of credit investing as a broader opportunity set for sure.
So let's call it special situations, which again includes different types of things. I'd be very interested to pick your brain on that, as you've got a lot of experience in that field, and also to understand this segment better. So we've talked about private credit. Now, can we go a bit deeper into the situation? So you've already explained what it entitles, but maybe we can start by, who are the players and how those opportunities, those special situations emerge?
Sure. So look, if you go back 20 or 30 years, the distressed debt universe was a very, very, it was a backwater, for lack of a better word. You had very specialized players, usually small hedge fund type structures. Some of the big investment banks had trading desks that specialized in this. The desk that I joined at Merrill Lynch first back in 2002, that was a focus of ours. Really, it was in the distressed debt space, but we were part of our overall credit franchise, if you will. And it was really guys who had legal expertise in terms of looking at lender agreements. They had expertise looking at operations of companies and evaluating operations of companies, whether there was asset value in a distressed company or not. Some players specialized in real estate. So there were a variety of guys who really kind of came to market. some of the big names in the market, you'll recognize, right? Apollo was one of the early movers there, Oaktree, etc. So Lone Star, for example, has been in and out of the distressed market. There's been a lot of guys that have a lot of track record. A lot of those big institutions, Apollo, Blackstone, etc., they've grown into be huge diversified credit managers now rather than specialists in distressed debt. In today's market, I think you'll find that the specialists that play in that space tend to be smaller. Right. I think the funds are generally smaller. The workload is generally smaller. Finding opportunities is definitely a smaller market. Deploying money into the private credit direct lending market, you can deploy billions a quarter. Deploying money into the distressed debt market, it's much smaller of an opportunity. A fraction of it, a quarter, a tenth, whatever it might be. So it's really evolved. A lot of the big asset managers, they do have groups within them that specialize in distressed debt or special situations. A lot of those big institutions, they've had mixed results in terms of that part of their investing business. The reason for that are numerous. Sometimes those businesses are restricted from doing certain things based on the franchise that they're within. Investment groups within big banks, for example, have conflicts of interests with the rest of the bank, with their banking clients, with their financial institution clients and things like that. So they're not always able to go after the biggest and best opportunities out there. Some credit managers that have started outside the distressed space or the special sit space and moved into the distressed space have sometimes found it difficult because they don't necessarily have the right expertise. And they try to manage those assets with more performing credit teams, and they don't necessarily look at things the same way. So there's a lot of different players, and some guys move in and out of the market, but it's generally the smaller players, I think, that dominate now.
Yeah, so a lot of different players, and yes, we can understand that those players who were the specialists in that field first, you mentioned Apollo, if they now manage, I don't know how much, I know Blackstone manages over 1 trillion, Apollo must be in that vicinity.
Pretty close, yeah.
It doesn't make sense if you cannot deploy many dozens of billions into one asset class if you manage 1 trillion, right? It's just not worth. So
those big asset managers will look at the opportunity as very cyclical, right? Mm-hmm. So if there's a dislocation like we had in 2008 and 9, they'll go to their investor base and say, now it's time to raise more money for that type of opportunity, and they'll probably be successful doing that. They're still able to capture that opportunity when it exists. It's just as a priority in today's market, it's probably not very, very high on the list.
Yeah, we can understand how it's a more specialized for more specialized player and cyclical. But I also want to try to fully understand from the asset perspective, and I think it's pretty evident. Those are companies, I can imagine bonds or any other types of lending that have fallen in. Not things are not always perfect. And from my perspective, having had bonds that have fallen dramatically, I can understand, but maybe you can tell me how it works in your word. How some bonds, you've got a bond, the company is really not doing well. It's worth maybe, I don't know, let's say it's worth 20. Maybe is the company a going concern? There's a possibility. Could it has potential to go back to a 100, this bond sometimes? Is it more likely that it's going to be sold for pieces, and then is it worth 10 or 25? So from a very basic owner of, let's say, corporate bonds, I can understand how this is the situation. And I can understand as well how when you fall into that, there's like legal issues, discussions with the custodian and the board, and actions that you can take. So does that mimic a little bit the role of the special situation manager?
Yeah, sure. I mean, look, it's a multifaceted kind of job, right? I think I always say you need to be half lawyer, half financial analyst, and half management consultant to be a distressed debt guy, because you need the ability to look at legal documents, assess what rights you have, and be able to capitalize on those legal rights. You have to be a financial analyst. You have to look at the company and what it's doing and determine a value. And sometimes that's specific assets, and sometimes that's a stream of cash flows. Sometimes that's intellectual property. It could be many things. And then you also need to be a management consultant. Is this business capable of turning itself around? Are industry forces too far against this company that it'll never recover? Has something changed in the industry that's permanently impaired the ability of this company to make money, to make revenue, etc.? So you need a lot of different skill sets in order to be successful in this type of industry.
Yeah, that's what makes it quite fascinating, and where you can see the possibility of alpha generation, a word that's
Well, it's these things that really have always made that part of the investing spectrum very attractive to me, right? It's very dynamic, and it's very infrequent that you have two situations that are the same, where the analysis is exactly the same. It's very dynamic from a personal career standpoint, for sure.
And is there as well as as the type of asset class and the type of involvement that you can get, can the involvement go as far as being actively involved in restructuring the company, or is that very marginal in this skill set?
No, I think well, different investors, pursue this kind of part of the market differently, right? I think there are very good firms out there who actively try to take over companies, right? And they want to be very, very active in the direction of the company going forward, what the management team is, how the management team is incentivized, what the goals are, etc. And there's guys that are much more passive, that don't want that responsibility and don't want that work. The active role, I mean, it's very difficult, right? I mean, it's very, very time consuming. Sometimes investors go on the board of directors, for example, and take an active role in managing the company through their period of stress or distress or restructuring, whatever you want to call it. And there's guys that just don't like to do that, right? They'd rather invest in the market, buy and sell, and kind of move on. So it's really preference, and I think there's guys out there that do the ownership and control very well, and there's guys that prefer to stay out of it. But it's just preference, and it's a sliding scale in terms of what investors like to do.
Yeah, right. So yes, there's many different skills, many different players, and many different approaches to different case studies. But how do you look at it now from an investor or LP perspective? And also, who are the LPs that look into that? How does it fit into your portfolio of other assets?
Sure. I'll take the last part first. LPs are very similar to any credit strategy, any equity strategy. It's pension funds, insurance companies, sovereign wealth funds, family offices, endowments, etc. Some people prefer to do, this kind of niche strategy, and some don't. It's really more about their mandate than anything else. It isn't a big retail product. I don't know that there are many, retail type focus funds that specialize in kind of the distressed side of the market. What do I think about the current opportunity set? Well, look, we've had a relatively strong economy. We haven't had real big default rate spikes or anything like that, although there have been some large defaults themselves in Europe, for example. Are we going to get another big cycle like we had post the global financial crisis? I don't know. I kind of hope not. That was a pretty scary time for everybody, even though it produced a lot of opportunity set for distressed debt investors. It was a pretty scary time. So what I think is that there are always going to be idiosyncratic things happening in the market. Industries are always changing. Macroeconomics are always changing, which result in companies' performance changing and capital structures becoming different types of burdens for different types of companies. Look, but when we were in a zero interest rate policy post GFC for a very long time, people tended to buy real estate assets for very cheap prices, for very expensive prices, based on very low cost of funding. That ended in 2022. That created a lot of stress in the real estate market, for example, and that's kind of continuing now. And people have had to work through some of those areas of stress. I think things like software, where the market is very dynamic, things like pharmaceuticals, where things come and go and drugs get replaced by new technologies and things like that. There's always going to be winners and losers in every industry, and capitalizing and finding value where there is change in the market is significant. The telecom sector is obviously undergoing a lot of change right now, with mobile and things like that. So that's a place of potential interest to a lot of people. And there are very simple industries like, movie theaters, for example, right? I think a lot of those companies have gone through restructurings over the last 4 or 5 years. The future direction of those companies is still kind of undetermined. I think, younger generations just aren't going to the movies as much as, my generation did when we were kids, or things like that. So figuring out a path, is going to be significant. And some of these companies, they restructure multiple times, right? They get into trouble. They have to go to their debt holders to figure out a solution to keep the business going. Sometimes that solution works and sometimes it doesn't. It turns out to be worse than they anticipated and they need to restructure again. So there's always opportunities in the market, people underperforming. Will there be another cyclical downturn, like we saw in 2008? Like I said, I hope not, but I probably think so. It's just the natural cycle of things. You have to kind of play the opportunities ahead of you. I think one of the good things about investing in distressed debt usually is you're able to limit the duration of your investments, right? So if you're looking at an investment right now in something like NVIDIA, geez, it's very hard for me anyway to figure out how long they're going to be able to preserve their market leadership position and sell these chips for huge amounts, right? I mean, last week, Google was making inroads in partnership with Meta and stuff like that. It raises some questions. So investing in something like NVIDIA, I mean, you kind of have to have a 20-year view, right? And that's pretty hard. I think investing in a distressed debt situation where there is a restructuring either coming or ongoing, you can see what the path is. There's a relatively defined horizon, right? If I buy this piece of debt at whatever price, 60 cents, 70 cents, my goal is to get back this much money through this process. That will take 2 years. So it's it's much more easy to define your investment horizon, which I think, for me is a more comfortable way of operating in the market rather than taking a 20-year view on chips that I don't know anything about.
No, I get it. So from what you said, it's cyclical, but it's also very sector driven, and there's cycles, you said movie theaters and stuff like that, which doesn't have to be affected by the more global cycle.
Yep.
So it's not unlike short sellers in the equity market where we see them closing down, and it's not a booming industry at the moment. This is something different. And I also understand very well what you said in terms of the approach to the horizon and kind of probability of investment, right? I can imagine that this restructuring, well, maybe there's a chance it goes to zero. Hopefully it's low. And I can see the potential. Maybe I can assign it a probability, at least in my head. So how do, you mentioned that it's also not for every LP, but how do people approach it? Do they approach it mostly in a tactical allocation, or can it be like, well, I'll put a small percentage in a more strategic way because of those characteristics repeat themselves, and therefore I can see it as an asset class?
Yeah, I think both, right? Is unfortunately the answer. I think there's some investors there that they just like it. They like the things that I'm talking about, right? The predictability of it, the downside protection. Usually when you're getting into these things, you value the assets in a really deep way. If you're a company that owns production assets, real estate, whatever, you could value those assets and know if everything goes wrong and the company isn't able to turn around, what do you get? And you try to invest at a level that's below that asset price, right? So they like the predictability, they like the short duration, they like the returns. So, we're trying to make, people in my seats or my type of seats are trying to make, 15, 20%. We're not trying to make 5. So they like the returns as well. And other people will scale up and scale down depending on how they perceive the cyclical opportunity. They might give a manager X amount of dollars and invest while the market is, relatively benign. And if there is some sort of cyclical uptick, they look to increase their allocation. That's a lot of smart guys do that over different cycles. And I think that will continue for sure.
And how's those structures? You mentioned 15, 20%. Is there as well different tranches in a typical deal where, I'll try to package it into the more senior and secure, and you can also take the full risk and full upside?
A lot of that depends on the individual underlying, right? I think, smaller companies tend to have very simple capital structures, right? Where they maybe have one loan, maybe a private loan, a syndicated loan, whatever it might be. Those types of restructurings tend to be relatively straightforward, where you have one loan, you try to restructure it. Maybe there's a write-off of a certain amount of it in exchange for equity in a company, for example. Then you have kind of 2 tranches. You have the existing loan and the equity. Sometimes they trade together. Sometimes they trade separately. In different circumstances, you might have the opportunity to be in the senior part of that loan, the restructured loan only, or the equity only, or both. And it's really your preference. Sometime in these restructurings, companies run out of money, right? And, they have a big capital expenditure program where they need to continue in order to get to a place back in the market where they can be successful. So that new money sometimes comes in various different components, right? Some people like me would prefer to put that money in as a senior, very senior in the structure where you're well secured on existing assets. Sometimes that can be a very interesting investment just on its own, right? Where you can make, greater than a 10% type of return on a very safe piece of paper with a limited duration. So yeah, a lot of these situations, they present opportunities to be in multiple parts of the investable capital structure in these companies. And then when you get into bigger situations, there will be existing securities that are very different. So if you look way back into something like Lehman Brothers, there were various legal entities, various layers of indebtedness in that company. And, you could pick and choose which part of the capital structure you wanted to invest in at any time. There's obviously not been any insolvencies like the scale of Lehman Brothers in a long time, or the complexity, but occasionally that happens too. So again, you have to have your real investor hat on there, looking through the different types of securities, being able to value those securities, and what's the better relative value depending on what your mandate is.
Yeah, I guess there's been some interesting case studies with FTX as well, who had investments in the hottest companies or have our time, like Anthropic, etc. So it must have been a fun restructuring, dealing with that behind the scenes. The picture that I get is that this is the utmost active management that you can get throughout the investment space, because there's so many skills, so many layers, so many aspects of it. And therefore, it's kind of if there's one, we see this passive wave, if there's one place where it's not going to reach, I'm pretty sure this is that. And I also wanted to mention two things. First of all, this is something that I vaguely remember from my CARIA exam, that this asset class, and I can understand how, has it's from maybe the vague memory from a research piece from many years ago. I passed it in 2011, 12. But it has very different diversification characteristics. And of course, private credit, potentially private equity, I think it's debatable, have diversification benefits. But I can see how this asset class, just from common sense, has very, very different characteristics than my common bond and equity portfolio. And I can see how the credit side of things will be more related to the bond. But these could be very unique characteristics in terms of asset, and therefore very diversified.
Yep.
Is that something that people typically consider highly as LP?
Yeah, absolutely. But like I said, all of the situations that you invest in, they're all idiosyncratic, right? They're all different on various things. Sometimes something that gets into stress or distress, it's because they have too much debt. Might be a great company, they just have too much debt. Sometimes there's something significant that changes in the industry, which changes the valuation of the whole company. Sometimes it's, something as simple as a change to a sales force. But, there was one interesting situation in Germany that we invested in, and it was as simple as changing the sales force back to what it was to get the company to recover. So it's all sorts of idiosyncratic things. And when I think about, distressed debt investing, I think about it as event investing. You're investing around an event. It's a turnaround. It's something very, very specific. Can you do it? And therefore, your duration of your investments tends to be relatively short. Private equity, 7 years, 8 years, 10 years, sometimes for these companies to pay off, which could work out terrifically, right? You find a growing company in the private equity space, and you double, triple your money. It's very attractive as well. It's just, for me, it was always a bit more tangible to invest around these events and these value plays that helps you value things in a more concrete way, although very idiosyncratic for sure.
You mentioned patience as the edge and the importance of governance frameworks in these kind of deals.
Yeah. When a company starts experiencing change, let's put it that way, right? Something in the industry changes. People are reluctant usually to acknowledge it, right? People don't like change. Everyone thinks, things revert to the mean. So, they kind of blow it off. And, for people like me, that's the most dangerous part. That's the most dangerous time to invest, is when we don't really know. And I think a lot of people that are involved in the situation tend to have bias just because they've been involved in the situation. They tend to overvalue the ability for companies to recover. And part of doing this job the right way is finding the right entry point, the right timing, the right pricing to get involved in these types of situations. And it's very, very infrequently early. Patience does really matter in terms of getting into these things. And a lot of times that doesn't happen until, very long after things start to change. There have been a lot of situations where, we haven't invested until 2 years after we first encountered the situation. It took a long time for things to unfold. Sometimes there was fraud, which took a long time to uncover. But yeah, patience really, really, really matters. And jurisdictions matter too, right? I think going through one of these types of investments in the U.S. is vastly different than going through one of these things in Spain or France or Italy, for example. And a lot of things matter. Being patient, evaluating all of the facts, taking all of that into account really matters in terms of maximizing value.
Yeah, this is a very interesting thing to consider. And in fact, it's kind of the opposite of the hypes and webs and flows of what we see in public markets and everyday investing. You might think, or I don't know, cinemas are done. Well, I don't know. The cinemas, I still go to the cinemas with my kids a lot less than. So where are we in that phase? Well, obviously I don't know. I'm not asking for an answer, but I can see how the timing matters enormously. And there will be a lot thrown at you in the meantime, such as newspaper headlines saying it's over or it's back or something else, and a lot of noise that goes with the flow. So it's patience, and I guess it's also about defining your own analysis and obviously ignoring a lot of the noise that the word will throw at you.
Yeah. And look, sometimes. So sometimes for me, I've been in situations where I've just said, look, it's too hard. I don't know. I can't answer enough questions that I have to get comfortable with, with certain things. And, I think that, like, for example, there's some good examples of some small retail businesses, particularly in the apparel sector, for example, in Europe, that, like, they just kind of went away. Right. And there was huge competition from big players like Zara, for example, H&M, just overwhelmed some of these smaller players. And, there wasn't a value. There wasn't a value you could attach to. There wasn't a price. There wasn't a time frame, so you just have to, sometimes you just have to miss those things, which is important too. Saying no to stuff is almost as important as saying yes to stuff.
Great. Daniel, thanks very much for this deep dive into the world of private credit and special situation and distressed debt in particular. It's something that we're just scratching the surface, but at least we've got an overview of how complex, how opportunities are, how it works, and how many skills are involved in something that's truly an actively managed asset, and it cannot be otherwise. As we finish, I just want to also pick your brain on a broader industry trend. And you said it's not about, it's not touching so much special situation. It doesn't lend itself to that. But generally speaking, with your experience in private credit and private assets, there's the move towards retail. I mean, it's more than a move, it's in action, right? BREIT has 140 billions in assets or something like that.
Yeah.
So what's your view and your perspective on that?
Let's see. I think generally, I think it's good, right? I think done in the right way, giving investors the ability to diversify into different asset classes is always going to be a good thing, right? I think it's something that retail investors, I think, need to understand really before they kind of go into it, what it is, why they're doing it. There are listed vehicles for private assets that have been around for a long time, right? In private equity, et cetera. So it is kind of the natural progression of things. All of the big investment trust structures in the UK, for example, are retail products, and a lot of those are back to or invest in private assets. So there's good and bad. I think from a grand standpoint of giving retail investors the ability to invest in these type of products, I think is a wonderful thing.
But the question is really about can it be done in the right way for the investors, or is there too many opportunities to use the fact that perhaps those investors will be less regarding, not looking at the full memorandum?
Yeah, I do think it's different. That's what I was going to say. I think in general, it's a good thing, but I do think it's a different asset class, right? So if you take the investment trust, for example, right now, like they trade at a huge discount to what their recorded NAVs are. And there's some investors in the market that are trying to help crystallize some of that discount by doing certain things. But, if you think about those structures, the management of those structures don't want these things to liquidate, to go away, right? They want to keep their management fees going, right? So there are things that kind of get in the way sometimes of making them perfectly efficient. That being said, there is the ability to trade them very effectively. Like I said, like the investment trusts, some of the BDCs, maybe some of the REITs in the US, they trade at discounts, right? Like, figuring out if that's a good time to invest, that's a really good thing, right? I mean, it's a very different analysis than looking at something like Microsoft now. It's a very different asset. You could like Microsoft and you can also like some of these, discounted private asset plays, and it adds diversification for your portfolio. Will there be fits and starts and ups and downs and winners and losers in the retail space, that get involved in this stuff? Yeah, there will be. I do hope that people have their eyes wide open when they go into an investment like that are able to evaluate it properly. But if you treat it like any other asset class, there's a good time to buy it. There's not a good time. There are bad times to buy it. From that perspective, I think it's a good thing.
Yeah, I guess it's a very broad question, and there's also very many different types of wrappers, such as evergreen funds and stuff like that. But I think the investment trusts are a particularly interesting one because we've discussed it in another podcast. They are, in fact, very fair in terms of their valuation because, it's dependent on the demand, right? On supply and demand.
Yeah.
And they do something, and yes, they do offer, those characteristics and different asset class and offer embedded liquidity. And therefore, I think it's, when you pick that, but it seems to me that it's a good wrapper for the structure that perhaps avoids some additional dangers that the semi-liquid funds have, because obviously the danger with the semi-liquid fund is that it can be not liquid at some point.
Yeah.
And it's a Victorian invention, right? The investment trust, which is particular to the UK, but there's equivalents. It's an interesting structure per se, and not that hyped, but it's a good democratization wrapper, I would say.
Yeah. No, like I said, as long as people have the ability to evaluate these things properly, or the expertise to evaluate it, they can be great investments. So I think it's for me, having more variety is always good.
This has been fantastic. Thank you so much, Dan.
Great.
We'll put the links to follow you up on LinkedIn or in Forward Hill. But we're very grateful for this. This has been a rare opportunity to have unique insight into this particular area of finance. And we wish you all the best with your future venture.
Terrific. Thanks very much, George.